What is credit? Simply put, credit is your ability to obtain goods or services before paying for them, based on the trust that you'll pay later. It's like a promise you make to the lender that you'll pay back the amount you owe, often with some extra money called interest. When you use credit, you accumulate debt. Now, what's debt? Debt is the amount of money one party borrows from another. It can be in the form of loans, credit card balances, or other financial obligations. It allows you, businesses, or even governments to make big purchases or investments you might not afford otherwise. This can include things like buying a house, starting a business, or funding public projects. Think personal loans, mortgages, car loans, and credit card debt. These are all common forms of debt that people use to manage their finances and make significant purchases. There are two main types of debt, secured and unsecured. Understanding the difference between these two is crucial for managing your finances effectively. Secured debt is backed by collateral, an asset you pledge to secure the loan. This means if you fail to repay the loan, the lender can take the asset to recover their money. For example, a mortgage is secured by your house. If you don't make your mortgage payments, the bank can foreclose on your home. If you fall behind on payments, the lender can take the house. This makes secured debt less risky for lenders but potentially more risky for borrowers. On the other hand, unsecured debt has no collateral backing it. This type of debt relies solely on your creditworthiness and promise to repay. Credit cards are usually unsecured. Because there's no collateral, lenders take on more risk, which often results in higher interest rates for borrowers. Next, let's talk about revolving versus installment debt. These are two different ways debt can be structured. Revolving debt allows you to borrow a set amount of money repeatedly. As you pay off the balance, you can borrow again up to your credit limit. Credit cards and lines of credit fall into this category. They offer flexibility, but can also lead to high-interest debt if not managed carefully. Installment debt is where you borrow a fixed amount and repay it in regular installments over time. This type of debt has a set repayment schedule. Mortgages, car loans, and student loans are examples. These loans have fixed terms and payments, making them easier to budget for. Debt agreements come with specific repayment terms. It's important to understand these terms before taking on any debt. You might have fixed monthly payments over a certain period or more flexible terms. Knowing the details can help you manage your debt more effectively. The two key components of debt repayment are principal and interest. These determine how much you'll ultimately pay back. The principal is the amount you borrowed. This is the base amount that you need to repay. Interest is what accumulates over the loan term, usually expressed as a yearly percentage of the principal. It's the cost of borrowing money. Lastly, let's talk about creditworthiness. This is a measure of how likely you are to repay borrowed money. Lenders assess your creditworthiness to decide if you're likely to repay the loan. They look at your credit history, income, and other financial factors. This is often based on your credit history and credit score. A good credit score can help you get better interest rates and loan terms. And there you have it, the basics of credit.